Hello everyone, this is Jen Han. Welcome to my channel, the channel that teaches you about finance and investment in an easy way. And don't forget to hit the subscribe button. I believe every one of you must be wondering, can I still invest in 2021? And how should I invest my money? Before I answer your questions, please allow me to share a bit of my story. When I first started investing, I was clueless about the stock market. I just bought the stocks that I heard before and just hoping the stock price will rise so that I can earn some profits by selling the stock at a higher price and buy again when it drops. Well, the concept is right, but the method was wrong. I was losing money through the stocks that I bought, and eventually I had to cut losses when the pandemic hits in March 2020. Then, I realized I need a guide. I read many books and listened to many investment talks. And I discovered one common method that many successful investors use, which is value investing. What is value investing? Let me first introduce to you a rich old man, Warren Buffett. Normally, rich people make their fortune through building a business, but for him, he did it only through investing. He started investing at the age of 11 and became a millionaire at the age of 30. Today, he has a total net worth of 84.6 billion US dollar. So what is his strategy? Value investing. To understand what is value investing, we have to first separate the two words, value and investing. The first term, value. Now, remember this phrase, price is what you pay, value is what you get. For example, if a phone that you want normally costs 2,000 ringgit and stays for this price for a few months, then during 11/11 campaign, the price drops to 1,500 ringgit. Now, surely you will buy because the price you pay has dropped below the value of the phone. The second term is investing. Let me give you an example about durian, since most of the Malaysians like durian. During the durian season, many traders went to Rau to buy durians at a cheaper price. Then, they bring the durians back to KL and sell them at a higher price. This is called trading. Let me give you another example. You buy an empty land and plant durian trees. After 10 years, the durian trees start to produce fruits, and you can now sell them to the traders. Now, you can enjoy earning profits every year without much cost, as the durian trees will bear fruits on its own. This is called investment. In the stock market, traders buy a stock based on the price, but investors buy a stock based on its value. So how to determine its actual value or intrinsic value? There are three simple ways to find out without having to use any complex calculations. Price to earning ratio, price to book ratio, dividend yield. Price to earning ratio, or PE, means how many years to reach the break-even of your investment. Taking an example of a fixed deposit with an interest rate of 4%. If you put an initial investment of 100 ringgit in FD, every year it would generate 4 ringgit for you, and this takes 25 years to reach break-even. In other words, the PE for FD is 25. Hence, we can set a benchmark to compare the stocks with FD's interest rate. Stocks that are having PE less than 25 are considered cheap, and those higher than 25 are considered expensive. Price to book ratio, or PB, compares the price you pay for the stock over the net assets value of the company. For simplicity, if the total assets value of a restaurant is worth 100,000 ringgit, such as the tables, chairs, lightings, decorations, and the owner willing to sell to you for a price of just 100,000 ringgit, then the PB is 1. Stocks that are having PB of less than 1 are considered cheap, and those higher than 1 are considered expensive. Dividend yield, or DY, is an indicator similar to collecting house rental or interest rate from FD. Let's say you bought a house worth 500,000 ringgit and you rent it for 2,000 ringgit per month or 24,000 every year. If we take the annual rental income divided by the cost of the house, you will get a 4.8% of return. In other words, this is similar to the dividend yield of 4.8%. We can also compare it with FD. If the current FD rate is 4% and there is a stock that offers you 6% of dividend yield, it means the stock can generate higher returns to you than FD. Did you know that you can buy REITs or real estate investment trusts and earn up to 8% of dividend yield? I'll explain more about REITs in the next video. So now you know how to define cheap in your stock market. It doesn't mean a stock price that lesser than 1 ringgit is cheap and a 10 ringgit share is expensive. To find such stocks that meet this criteria, we can use a free Malaysia stock screener website, KLSE Screener. You can also use this on your phone. Just download it from your Apple App Store or Google Play Store. In the Google search, type in KLSE Screener. Then click the first link. Firstly, we said we want to find the stocks in the main market. Then key in the criteria that we want. For PE, we set a maximum of 25. For the dividend yield, we set a minimum of 4%. Then for the price to book value, we set a maximum of 1. You may also choose to show only Sharia compliant stocks and click screen. Now, you have a list of stocks to select. But this doesn't mean you should just buy any stocks that show here. You must always study the company first before deciding to buy. You can read the company's annual report from here for more information about the company's performance. Investing is easy, but you must know what you are investing. I hope you enjoyed the video and do hit the subscribe button if you wish to see more of these videos. Do comment below if you have any thoughts. See you on the next video.